Is the US heading for a major recession in 2025? Some experts are raising alarms, pointing to high inflation, rising interest rates, and global instability as warning signs of a downturn. Others argue that strong job growth and consumer spending might keep a recession at bay. So, who's right? And more importantly, how will this impact your wallet? Will housing prices crash? Are we on the verge of mass layoffs? Could your savings lose value? In this video, we'll break down the biggest economic warning signs, expert forecasts, and historical trends to uncover the truth. We'll also examine what the Federal Reserve is doing and how global events might shape the US economy. By the end of this video, you'll know what to watch for and whether you should prepare for tough times ahead. Let's dive in. The current economic landscape. To determine if a 2025 recession is likely, let's examine key economic indicators. First, inflation. Prices have soared in recent years, prompting the Federal Reserve to raise interest rates aggressively. While inflation has slowed, it remains a concern. If prices keep rising faster than wages, consumer spending, the backbone of the US economy, could suffer, triggering a downturn. Then, the job market. Unemployment remains low, but hiring has slowed and layoffs are increasing in industries like tech and finance. If job losses spread, consumer confidence could drop, reducing spending and further weakening the economy. Another factor is GDP growth. While recent quarters have shown resilience, analysts warn that growth could slow or turn negative. Historically, 2 consecutive quarters of negative GDP growth signal a recession. Finally, the Federal Reserve's interest rate policy is a major factor. Keeping rates high could slow growth, but cutting them too soon might reignite inflation. The Fed is trying to balance these risks, but any misstep could push the economy into recession. Expert predictions and warning signs. What do economists say about a potential 2025 recession? Opinions vary, but several warning signs stand out. One major red flag is the inverted yield curve, a classic recession predictor. When short-term interest rates are higher than long-term rates, it often signals an economic slowdown. Historically, this has preceded every US recession in recent decades. Another concern is corporate debt. Many businesses borrowed heavily when rates were low, but now face rising repayment costs. If companies start cutting jobs or freezing investments, economic activity could decline. Consumer debt is also a growing issue. Credit card balances are at record highs, and delinquency rates are rising. If people struggle to repay debts, spending will slow, weakening business revenues and increasing layoffs. On the other hand, some experts believe a soft landing is possible. The Federal Reserve is carefully adjusting interest rates to control inflation without crushing the economy. If they succeed, the US could avoid a deep recession and instead experience slow but steady growth. However, external factors could complicate things. Geopolitical tensions, global supply chain disruptions, or a major stock market crash could push the economy over the edge. History shows that recessions often come from unexpected shocks, like the COVID-19 pandemic or the 2008 financial crisis. So, what does this mean for you? Let's break down how a recession could impact jobs, housing, and investments. What it means for you. If a recession hits in 2025, how will it affect your daily life? Jobs. During recessions, businesses cut costs by laying off workers or freezing hiring. Industries like tech, finance, and retail could see major job losses. Now is the time to build an emergency fund, update your resume, and explore multiple income streams. Housing. In past recessions, home prices have dropped due to weaker demand. But with high mortgage rates, the housing market is already in a tricky spot. If a downturn hits, selling a home or getting a loan could become more challenging. However, falling prices could create opportunities for buyers looking for long-term investments. Investments. Stock markets typically decline during recessions, affecting retirement accounts and portfolios. If you have money in the market, experts recommend staying calm, diversifying investments, and avoiding panic selling. Many investors see downturns as a chance to buy undervalued assets for future gains. Daily expenses. A recession could bring lower prices on goods and services, but also higher unemployment and tougher loan approvals. Managing debt wisely and planning ahead can help weather financial uncertainty. Conclusion: should you be worried? Is it time to panic? Not necessarily, but preparation is key. Some indicators, like the inverted yield curve and rising corporate debt, suggest a downturn is near. Others, like low unemployment and steady consumer spending, point to resilience. The economy is at a crossroads, and the next few months will be critical. One thing is certain: being financially prepared is your best defense. Now is the time to build savings, manage debt wisely, and stay informed. Recessions can be challenging, but they also create opportunities for those who are financially ready. The smartest move: stay calm, think long-term, and make strategic financial decisions. What do you think? Will we see a recession, or will the economy hold strong? Comment below. If you found this video helpful, like, subscribe, and hit the bell for more financial insights.